but I am conscious we just have the hour to get through kind of a meaty agenda with some great guest speakers as well. So just going to pass you over to Peter maybe to kind of kick us off. So Peter's going to be our MC or our host for this morning and kind of guide us through the agenda. So maybe over to you, Peter, to start.
Okay, yes, and thanks very much, Chris, for today. It's really nice to be here. I know it's a busy morning for a lot of folk out there, catching up on regulatory issues after the Easter break, if you did take time off, or maybe you were running around doing things for the kids in those 2 weeks as well. So in terms of housekeeping, just to say, Chris Hanlon from calQrisk is behind the scenes here. He's going to talk as well, but occasionally you may hear us call out to Chris and he might be sending us through some questions and things of that nature. So just in case you hear that, just to explain why. In terms of today, we've got a great lineup of speakers. I'll be introducing one of them a little bit more than I'm going to do than at the moment, but you're going to still see the names of Tracy, Chris, Edith, and myself pop up. And there we are. So many thanks to Tracy Tuki and also to Edith. We have an apology there, Chris, from Tracy Gernon, who unfortunately is unavailable today due to something that's unavoidable to join us. However, we've done a lot of preparation for this session, and I also work in Tracy's area of e-money and payments, so I suspect that Tracy Gernon and I would have had a lot to have a chat about, so I'll probably carry some thoughts across for her as well from my background. Look, it's a pretty interesting time right now, very quickly, in terms of our agenda. You know, what's going on with the regulatory changes that are coming along. I just point out that at 11 o'clock today, whilst we're in the throes of the webinar, the central bank is scheduled to be releasing a Dear CEO letter for e-money and payments firms, and that will no doubt build upon some of the topics they spoke to the industry about in February and actually earlier. So we're seeing a raft of regulatory changes, but one of the most important things I think is to remember is that if it feels a bit isolated in Ireland doing this, you're not alone. There's another big batch of people in the European Union who do risk and compliance roles facing exactly the same problem, because we now receive more EU regulation law that we implement than actually local financial services law that we implement. So there is obviously that word union in the European Union is pretty strong at the moment and will continue. So we'll talk about the past regulatory changes, the present, you know, what's coming down the line with individual accountability framework. Looking forward to that session. I expect many people on the call work on the boards of firms, so that's something for us. The current regulatory challenges with Fintech, which I'll take us through. And also we have the future, the regulatory supervisory outlook, and of course we're going to have the Q&A and things of that nature. So I think adding, other than that, Chris, I don't think I left anything out at this point. We have a couple of topics to come up. Do you want me to keep going on these, or do you want to bring somebody in?
Yeah, no, I think we can kick off basically, if that's okay. You've touched on the housekeeping points as well. So the session is being recorded, and we'll send over the slides and the link to the recording as well later on this afternoon too. So if you miss anything or we skip over anything, please do feel free to pop it into the Q&A box. But if not, we'll send out the resources later on this afternoon as well. So I think if it's okay with you, Peter, I'm just going to talk just for a couple of minutes on the past piece of that agenda on the recent regulatory changes around outsourcing and operational resilience. They're kind of two of the probably the sector-wide challenges that we've come across that is hitting every kind of regulator, every license holder basically under the central bank. And not to be the bearer of bad news, I just wanted to kind of highlight some of the common challenges that we're seeing really right across the whole sector, depending on, or regardless if you're a 500-person firm or a 50-person firm. So on outsourcing, one of the things that we're seeing as well is really people struggling with what is a critical provider and who put on the outsourcing register. So we've seen some people have an outsourcing register with 2 lines. We've also seen other firms have outsourcing registers with 250 lines on it. And they're taking everything from their payroll software right through to their CCTV provider, right through to AWS, who is hosting their CRM system and things like that. So the main thing that people are probably tripping up over there is just documenting everything, but without the methodology or rationale as to why they're actually adding it to the outsourcing register as well. So that's one of the things we see kind of popping up on internal audit reports now that the outsourcing guidelines is that bit old or that bit more implemented. One of the other things we're seeing in larger firms, and I know a lot of people on the call today might be subsidiaries of larger kind of UK or US parent groups or companies, the intra-group outsourcing and the kind of the tricky nature of that, basically, particularly where you could be sitting on the same floor in the same building as your outsourced service provider. Do you still have to do due diligence on them? How do you actually do that in reality? And how do you obviously evidence it then to your local board and then to the regulator as well, that you're doing that robust due diligence, even though it is all potentially in-house? Governance is one of those things as well that when you read the guidance, a lot of people probably have built separate outsourcing frameworks, and there is a bit of people are building rather, or people are bolting it on to something else, maybe rather than having something standalone. Then there's another train of or school of thought where have it as a standalone thing. So again, everyone's slightly different there in terms of having actually a separate outsourcing framework. I've even seen some firms go as far as having outsourcing committees. Some are using their audit and risk committee to kind of report into, but just some challenges around the governance, the policies and the procedures. And one of the things that's becoming clear as well is that people are putting stuff in their outsourcing policy, but maybe doesn't match their ERM framework or their ERM policy as well. So just to be conscious of those kind of potential hiccups that might happen there too. From the risk management point of view, there's lots of requirements basically in the outsourcing guidelines, both coming from Ireland, the UK, and even further afield in Europe through the EBA and regulators like that. From the risk assessment point of view, one of the things we're seeing a lot of firms get kind of bogged down in is the internal versus external risk assessment. So an internal risk assessment around how robust is our outsourcing framework, our policies, procedures, and governance, but then also maybe clogging up the risk register with risks that are super specific to an individual outsourced service provider, for example. So again, there's a couple of different schools of thought around whether we should have a separate outsourcing risk register that contains very specific risks to different service providers. And then just one or two other points on the outsourcing then on due diligence, the kind of the challenge between the initial onboarding of a service provider or an outsourced service provider, that initial onboarding, maybe a more lengthy kind of due diligence check versus the ongoing monitoring. And I think where a lot of people are struggling with the ongoing monitoring aspect is it just a time bound? So is it just something you do every 3 or 6 months? Or is it trigger based? So is it that the supplier changes their SLA or their contract or whatever it might be? So there's some of the bits and pieces. And then finally, the last thing I just wanted to point out on the outsourcing register was on outsourcing was the outsourcing register itself. So some firms obviously are required to submit it. Other firms are just required to maintain it and have it available upon inspection or ready for inspection if they're requested. So again, despite the central bank kind of having fairly robust templates, which are a bit of a nightmare to manage, the reality is that a lot of firms are it's out of date. It's probably come close to a tick box exercise as well. And it's very siloed from our experience as well, in that it's typically 1 or 2 people in larger firms who are managing it. And they may not even know everything else that's going on, if that makes sense. So how do we actually operationalize that? So there are some of the big challenges that we're kind of seeing coming across the outsourcing aspect. And then just literally 1 or 2 minutes on an operation resilience. So very similar to the critical service provider piece on the outsourcing. A lot of firms really struggling with what is an important business service. So is it something like payments or is it refunds? So how granular do we actually go? How do we define the logic or rationale behind us saying if this is important or critical? And as I mentioned, that granularity thing is going to probably tread through these 3 or 4 points I have here as well of where's the start and end point. Impact tolerance is quite a big one. The CBI, I think, are quite specific in that they're looking for some time-bound metrics. But I think there's lots of other things that people can use that they already have. So like if you already have an existing suite of key risk indicators, or if you have a KRI framework, are any of those impact tolerance metrics for business services, as opposed to just saying our system can't be down for 6 hours because we can't provide service to 40% of our clients or whatever it might be. So I think firms have a lot of work already done there over the last few years in terms of key risk indicators and things like that. The last two then are kind of somewhat linked as well. I just want to kind of pop them both up on screen at the same time. So the project versus business as usual. So unfortunately, with all these regulations, and I'm sure it's going to come up as we step through this, the volume or breadth of regulation being introduced kind of leads itself to almost being project-led implementations. And then it's the operationalization or the implementing it to a business as usual where a lot of people are struggling. And that's where I want to just touch on process mapping as well. a lot of people have seen operational resilience as it's process mapping. We need to sit down, lock ourselves into a committee meeting room or something like that for 3 months, map out all our processes, and then just save them somewhere and that's it done. It's how do we actually bring it to life and demonstrate that we have a more robust organization as a result of doing all this work, and what is the ongoing monitoring looking like? So unfortunately, the process mapping isn't the end to a certain extent. It's just the beginning of the operational resilience journey. So I'm conscious I did skip you down to that quite quickly, but I do want to leave lots of other time for the other speakers as well. So if anyone does have any questions, do feel free to pop it into the Q&A, and we might address them later on. But if not, maybe over to you, Peter.
Thanks very much, Chris. I mean, I think the critical and important business services point you raised is very interesting. I would suspect a number of people on the phone, on the webinar as attendees and panel members have probably had dialogue with the central bank over the identification of those. And I guess arguably you could read that, you can read these requirements, and you don't necessarily have to identify a critical business service, but you'll probably find that the regulator will want you to have at least one of your risks, one of those services identified as critical. So, you know, that wasn't really thought of initially when these things came out, because the way you can read the legislation, or you can read the requirements, I should say, is that you may not identify one, but actually it seems that everybody, according to the central bank, must have at least one or two. Having 12 probably means you've got a bigger problem. I think in relation to the other point you made, Chris, these things resonate with myself, and I know many others on the call. We all look at this differently from the aspect of being in operations or risk management, which is really important, you know, in the engine room to get these things done. But we also need to look at the symbiotic relationship with those on the board, for example, and not just the management team on the board, but also on the independent non-executive directors, and the requirements which Tracy's going to take us through in the changes to the IAF. So it's sort of funny how these things all look like they're in silos, but they all somehow end up being interconnected. So that's tremendous. So my pleasure now. I think, Tracy, I'm going to turn to yourself. Tracy, just if I give Tracy an introduction before she kicks off, I'd say a few of you probably will know Tracy from around the traps. I'd say what Tracy is involved with today is providing governance, advisory, training and consultancy services to businesses and organisations across quite a broad spectrum. Obviously, today we're talking about that in terms of financial services, but what's interesting is how Tracy got to where she is today. So that's built upon 25 years of global regulatory compliance, governance and risk management experience. That sounds a lot nicer than saying a quarter of a century, Tracy, because that would make you feel a lot older if I said that, quarter of a century. And you've worked as a senior practitioner with the financial firms in the regulatory sectors. I've come across you obviously in the funds industry and other aspects. But you've been involved in data protection, so the GDPR, the Digital Services Regulation, obviously what you're talking about now in a few minutes, the Individual Accountability Framework, Enterprise Risk Management, which is a phrase I see used a lot more in the Republic of Ireland. I used to see it quite a lot in other jurisdictions, but it's really coming home, the whole ERM. For your sins, you've been involved in internal audit, regulatory policy, management and leadership roles, and also the other big challenge we're all going through now, ESG. So I know you've been involved in PCF roles and having done those roles yourself, the 12, which is compliance, 13 internal audit, and 14 the chief risk officer. And I also know that you've done that work actually not just within the Republic of Ireland, but the equivalent roles in jurisdictions like the UK and Bermuda and the Cayman Islands. So you've also got the unholy trinity because you've been the MLRO. So I guess the buck stops with you, Tracy. So there's no better person to turn to pick one's brains on the IAF than you.
Thank you, Peter. I feel exhausted after that, actually. It sounds like I've been very busy. So thank you for the opportunity to talk today, Chris and Peter. And, you know, I guess quite relevant as we're talking about increasing regulatory requirements in the sector. Coupled with that, we're having an increasing level of accountability for people who are responsible for making sure their businesses comply with all of these regulations, and as they continue to evolve and increase. Okay. So on to today's session, I just thought I would give you just a whistle-stop tour, I mean, a very high-level overview of the individual accountability framework. Just conscious that there may be a wide range of people attending today, and some of you may have an in-depth knowledge of this framework, and some of you may have less. So it's just something to take away with you, that you can kind of understand what this framework is all about, and, you know, where necessary, can assess whether, you know, that's applicable to your role, your business, and, you know, how you're getting on with implementation and so on. So I'm going to give a very high level overview of what it's all about. I'm going to just pull out some particular aspects that are relevant to personal accountability under the framework. And I also just wanted to make you aware that the Compliance Institute and the Institute of Bankers are going to be running a short 6-week course on this framework. It'll be beginning on the 30th of April, and on completion, you would be awarded a digital badge, and there'll be CPD, of course. So keep an eye out for that. I'll be lecturing on that course, and there will be guest speakers and practitioners from industry joining me to particularly focus on the practical implementation aspects, because as we all know, that's what's important. Getting back into the project and the BAU and actually doing the work on a day-to-day basis to maintain compliance. So just keep an eye on that as well. I'll give some details on that at the end if you want a bit of a deeper dive on the framework after this event. So distilling it right down, the IAF, the framework, is comprised of 4 main pillars. The first is the Senior Executive Accountability Regime, and you'll hear people talking about SEAR. The other is the conduct standards. Then the framework also enhances the current fitness and probity regime, which you'll probably all be familiar with. And also there have been amendments to the central bank's administrative sanctions process. So just to explain about SEAR, SEAR applies to PCFs, that's pre-approved control functions, at in-scope firms from the 1st of July this year. And the only exception to that is the PCFs of non-executive directors and independent non-executive directors, and they become in scope slightly later, a year later. So anyone who's in a PCF role in a firm that is in scope for SEAR obviously needs to be very cognizant of the responsibilities and etc. that this regime places upon you. So just to clarify which firms are in scope of SEAR. So credit institutions are in scope except for credit unions, insurance undertakings except for reinsurance, captives and SPVs, investment firms that underwrite on a firm commitment basis, and hold client monies, etc., and incoming third country branches, all of them. So that's the types of business that are in scope of SEAR. So what is SEAR all about? Essentially, it is designed to improve governance, performance, and accountability within our organizations. And it's designed to ensure that people in these roles and governance arrangements, etc., within the firms set out a clear picture of responsibility and decision making. So for those PCFs that in scope firms, there's sort of 3 levels of responsibilities that apply to them. There is inherent responsibilities. They are the kinds of things that you would naturally expect to be core to a PCF role. And as we know, there's different kinds of PCF roles covering different kinds of business areas. And then there are prescribed responsibilities, and those are the ones that are allocated by the management, you know, by the firm to suit their specific needs of the business. And they need to be allocated by the firm as per the SEAR regime. And then there are other responsibilities that could be very, very specific to the role, projects that the people are involved with, etc. So there's 3 levels of responsibilities. The inherent and prescribed responsibilities are set out in the regime, need to be allocated, etc. And then the other responsibilities are very much a matter for the firm to decide. So SEAR introduces a statutory duty of responsibility, which is enforceable against individuals. And anyone in a PCF role must take reasonable steps to avoid contravening the obligations of the firm within financial services like legislation. There's also a requirement for a statement of responsibilities to be compiled for each PCF. And that statement of responsibilities must set out the inherent responsibilities in the role, the prescribed responsibilities as applicable to the role, and any other responsibilities relevant to the role that the firm may designate to a person. And there's also a requirement to have a management responsibilities map. And basically that's a map setting out all of the key management and governance arrangements within the firm. And the firm must ensure that there's no gaps in responsibilities. So by creating this map, the firm should be able to identify if there are prescribed responsibilities or critical or material responsibilities and functions that don't have a home and essentially need to be allocated to senior individuals within the business. So the other component, the other pillar is the conduct standards. So the conduct standards for individuals are set out in the framework. Now there are other business standards that the central bank will be reviewing as part of their review of the consumer protection codes, and they will follow. But the conduct standards for individuals I'll focus on today, and they've been applicable since the 29th of December last year. So there are different layers of standards. So there's the common conduct standards, and they apply to all individuals that are in control functions as defined under the fitness and probity regime, except for those in holding companies. And there are then a higher level additional conduct standards which are applicable to people in PCF roles and anyone with a CF1, a control function 1, and that's significant influence people. And the conduct standards, unlike SEAR, they apply to all sectors. So essentially, individuals in these roles have a duty to take reasonable steps and to make sure that they're fulfilling their duties, applying the conduct standards, and all the different conduct standards are set out within the regime. So people need to be very familiar with what they are. Breach of the standards will be directly enforceable by the central bank under the revised ASP. Guidelines are available as well on the central bank's website, and a breach is also reportable as a prescribed contravention. So as we know, or some of you may know, PCFs have an obligation to disclose or report prescribed contraventions to the central bank, and a breach of the conduct standards is one such thing that would be within scope for that kind of reporting. Okay, the other strand is that the IAF has resulted in enhancements being made to the current fitness and probity regime. So there are prescribed new and amended PCF roles and CF roles that are set out that didn't exist before. Also, the standards and guidance under fitness and probity have been updated. There's a new certification requirement introduced by the framework. And essentially that means that compliance with the fitness and probity standards for all control functions must be certified unless they're exempt, of course, from those standards. So firms have a new requirement to certify this. And then available upon request and baked into the overall fitness and probity returns. So you don't have to necessarily file these certifications, but you have to have them available from a supervisory perspective or upon request. And when you're doing your annual fitness and probity return, which you do already, it's kind of baked into that this certification has taken place. So the final aspect is that the changes have been made to the administrative sanctions process and procedures. So the central bank can now take direct enforcement action against individuals in certain circumstances, which is probably the key focus for individuals at the moment, you know, when they're thinking about their obligations under this framework and in general. The central bank is very clear in all of their commentary is that their intention is to be holistic, fair, and proportionate in their approach to taking these kinds of enforcement actions. And the revised regime provides for enhanced transparency as well around these kind of investigations and inquiries and so forth. So the central bank, you know, has stated that before they take enforcement actions, they will firstly consider how their regulatory objectives could be met in other ways, such as using supervisory powers or supervisory interventions, before resorting to taking enforcement actions against individuals. So there's a few things I'm just going to highlight. I mean, we could probably talk for an entire day about the individual accountability framework and indeed administrative sanctions and how they play out. But just to point out a few things that has changed is the responsible authorized officer for investigations. They have, you know, the clarity around this officer role and how the role that they play in those investigations. There's clarifications around disclosure of confidential information, which is obtained during the process of investigations and inquiries, and specifically that will be permitted if an individual is required to do so by law or to their legal advisor or as otherwise authorized by the central bank. There are around timeframes for responding to investigations. They'll be set by this RIO based on the case circumstances and what timeframe might be appropriate and fair. There's guidance around how the central bank may use information that they obtain during investigations and enforcement actions, and for example, clarification around the use of that perhaps for other purposes and when that can and can't happen. There's also some clarification around legal professional privilege and entry into disclosure agreements, and clarifying that it is on a voluntary basis, and also talking around, you know, how those disclosure agreements would work, and if someone is not wishing to provide information on the foot of a statutory request, things around there has to be, you know, a schedule, for example, in relation to the reasons and so on. There's also information around publication of details of notice of inquiry, around appointment of inquiry members, and in particular conflicts of interest and how they're managed. Also guidance and clarifications around the new settlement process, pulling out that the use of conditions as a sanction, for example, as well. Also around appeals and CBI functions, you know, in terms of the distinction between being involved in an investigation versus an inquiry, and also around legal representation for individuals subject to enforcement actions at any interviews. So that's really, you know, a very quick overview and very, very high level around the framework, basically what it is and some of the key things for people to be focusing in on. And just a reminder as well that that course is starting on the 30th of April, and details of that course are provided here, and have a look out on the Compliance Institute's LinkedIn, etc. as well for registration details. But that's for anyone who wants to kind of learn or needs to learn a little bit more about the framework, and in particular preparation for the upcoming implementation of SEAR. in July later this year.
Listen, thank you very much for that, Tracy. Continuous learning, yep, it's on all our agendas, and the IAF is going to be no different than that. Chris, I think we, so many thanks, Tracy. If we could do a round of applause, we would do that, but you're getting a virtual one as I talk. Chris, I think, should we jump onto the panel discussion? Does that work for you?
Yeah, absolutely. Yeah, I think that'd be useful. I think we have a couple of questions in already, and maybe just to kick it off. Tracy, there's one here just specific to IAF.
Sorry, Chris, sorry to cut you off. Should we just do a quick intro for Edith, because we haven't actually introduced her?
Sorry, Edith. Yeah. Fire away. Yeah.
So before Edith starts giving her words of wisdom, it'd be just to help folk understand what Edith does. And Edith Kennedy is with Virtue European Trading Limited, and she joined them just less than a year ago, I think, Edith, now. And you're the Chief Risk Officer. I do understand a bit about your business. I work in a company which does something similar to what you do. And you're involved in developing the risk management framework for the business, but I also see that you're part of the EMT, which is not the emergency management team, but maybe sometimes it feels like that. You're part of the European management team with responsibility for oversight, review, and challenge of first line activities. And then you also obviously have the reporting line into the CEO, but you report into a risk committee, and I really like that because I sit on a risk committee. It's excellent to get direct line reports in from CROs, the PCF12s, and others who know the business. Just same comment as Tracy, I'll say you have 24, 25 years of experience rather than a quarter of a century, but I just said it. But that covers banking, leasing, and a whole range of things, including the dreaded ICAP as well, and stress testing, which is so big these days, in scenario analysis. So I just thought we'd share Edith's background, so you might help calibrate or inform on some of the questions that may come up. But you're very welcome today, Edith, and thank you for joining us.
Thank you.
Yeah, yeah, look, as Peter said, if you do have any questions, do feel free to pop them into the Q&A box in Zoom here. So we do have a couple already. So I think this one's probably aimed at you, Tracy, looking kind of for the big difference between the existing fitness and probity regime and the new IAF. I know you've summarized it there, but it was quite a meaty thing. So what's the difference? And if I was a CF or a PCF, what are the kind of key differences between the IAF and the existing fitness and probity regime?
Okay, yes, no problem. So I suppose the regimes obviously complement one another, and there are, synergies across them both, because if you think about it, someone to be fit and proper, you obviously need to be adhering to conduct standards and so on and so forth. But I suppose to describe the main difference is that the fitness and probity regime is sort of designed to ensure that people in control functions and pre-approval control functions, which is a subset of control functions, that they meet minimum standards in order to kind of take on the role. So that's, fitness, which is their competence, their capability, also honesty, integrity, and so on. So that's kind of someone to be suitable for the role and then stay in the role on an ongoing basis. The conduct standards, for example, in the IAF is more about how those individuals comply with, operate and behave and conduct themselves whilst they're performing those roles. And the thing is, if someone is not complying with the conduct standards, then you might call into question their probity and therefore whether they meet the fitness and probity standards. But it's not a direct correlation. There's actually some roles, for example, that are exempt from the fitness and probity standards, but those people still need to comply with conduct standards under the IAF. So there's a slight, they're very similar, but they are distinct regimes, distinct requirements, and for slightly different perspectives in terms of how people should operate. And the individual accountability framework also made some changes to the fitness and probity regime. For example, extending it to holding companies, which weren't people who worked in holding companies were not previously in scope. And also requiring the certification, as well, which I mentioned during the thing. So they're similar but different, and there's a few distinctions there, but one could impact the other. So you could have someone who meets the fitness and probity standards but breaches conduct standards, you know, and that so they're different, but then you might call in to question their fitness and probity afterwards.
Gotcha. Yeah, that makes complete sense. I'm just trying to group up some of the questions here. I think there's one kind of overarching theme, I think, and it's more around the kind of breadth of regulatory change, particularly where you're operating across multi-jurisdictions as well, I suppose. And maybe to bring you in on that, Edith, I know we had some chats around kind of horizon scanning and things like that. So do you want to kind of comment on that? There's no kind of specific question as such, as more of a comment of just like the breadth of regulatory change coming right across the EU and further afield.
Sure. Yeah. As Peter mentioned, I suppose I'm currently working in an investment firm, MiFID firm, and previous roles would have been across retail banking, leasing, and like many on the call, had the pleasure of working during the financial crisis in 2008, where we witnessed, I suppose, the first onslaught of real regulatory changes, which were obviously welcome and needed. But I suppose what we've seen over time is, you know, these regulatory changes, whether it's through MiFID changes, AML, resolution planning, and regulation being more centralized through the EU rather than, you know, your local NCA. We've a variety of different attendees on the call today, whether they're payments firms, financial services, investment firms. And the difficulty I see is that, you know, one size doesn't fit all. There's a lot of regulatory requirements coming specific on risk and compliance. And, you know, for smaller firms that do not have the resources, manpower to implement all these changes, you know, it is difficult. And, you know, it's on a best efforts, as opposed to, you know, you've got teams in maybe the bigger banks that can, you know, mobilize a team of 10 to look at GDPR for the next 2 years until they're happy it's, you know, in place, and then move on to Dora. Whereas I suppose in smaller investment firms or payment firms that are startups, you know, there's maybe a little bit of uncertainty of how far do they need to go on these. And, you know, it's something that they're doing as part of the rest of their day-to-day activities. And, you know, I think there has been a lot of movement across the, you know, the European supervisory authorities, and, you know, making that distinction between the big retail banks and, you know, the investment firms and the different risk profiles of those, and bringing in regulation on the back of that through IFR, IFD, and, you know, there's now SREP changes guidelines for investment firms as well. However, one of the big challenges that, you know, as an investment firm I'm seeing is that, you know, we seem to have one foot in every door still. We're not completely in IFR, IFD. We're not, you know, we're not part of CRD anymore. However, we still need to do part of it. You know, resolution planning, you know, it's very unlikely that the regulator is going to come in and, you know, save the investment firms, the payments firms. However, they may do so for the big retail banks, but we're still required to have full resolution planning in place, which is beneficial. I mean, I think, you know, the companies can see the value of doing all these activities. However, where resources are tight, you know, it does provide challenges.
Yeah, and that common thing kind of trade through there around resources as well, I think, Edith, and maybe just to bring Peter in on that too. And dare I say, Peter's an ex-regulator as well. So, but Peter, to get your opinion on kind of the non-regulatory challenges maybe as well, like Edith mentioned, just around trying to keep up with the pace of change and even the resources side of things from what are typically leaner firms, maybe than some of the kind of pitter banks across Europe, for example. So not to put you on the spot, but yeah, have you any thoughts or opinions on that?
Oh, look, I mean, you know, one of the topics we sort of is quite, you know, hot at the moment, has been for a number of years. People want to talk about fintech, and fintech's actually very broad church, isn't it? I mean, some people call fintech just the newer disruptors. There are firms that have been around for a number of years that have always been digital. They've traded digitally, they've provided banking service digitally, and they fall under the Fintech banner as well. But one of the challenges, I think, obviously right now, what worries regulators has been the higher interest rate environment. Now, if you look at the central banks, they've been saying well before interest rates went up that we should be getting ready. Sharon Donnery at the Central Bank of Ireland was actually saying that a number of years ago, indicating, well, what goes down will go up. And that was in terms of interest rates. So interest rates going up means that there are some companies out there that rely upon funding, which comes from the markets, and that money may not come because they're getting a better return from somewhere else instead of investing it into a financial technology company. And if you rely upon venture capital funding and you're a regulated fintech, you know that your regulator is going to have a lot of discussions, or may want to have a lot of discussions with you when you go through the authorization process about your financial resilience, because they don't want to authorize a firm today that won't be around in a few years. Some people sort of think that's a bit of a glib point, that's not really of interest to the regulator, but I've had that discussion actually with a deputy governor of the Bank of Italy, and also people inside the central bank here in Ireland, and it is a concern for them. Obviously, the more digital you are, the situation with Dora, operational resilience, and raising the bar. And what I mean by raising the bar is building, assessing, and reviewing your operational integrity. That's what digital operational resilience is all about. And I know you've got some questions there, Chris. I'm just seeing there's some questions. I'm seeing some Q&As coming in as well there. One about outsourcing and metrics. Do you see that one there? And there's a few others on outsourcing. Just in case.
I think there's two here on outsourcing at the moment. So one is about any specific metrics from the CBI, and then about how frequent, I suppose, that we should be conducting risk assessments or due diligence on outsourced service providers. And is there anything specific on those? So my understanding is that the CBI haven't been so specific in saying that, you need to do this every 3 months or something like that. But I think the big thing where a lot of firms are struggling with it is documenting the guidance or the rationale as to why they feel that this is a critical or non-critical service provider, and then what it means internally as well. But to open up to the panel here as well, has anyone any thoughts or opinions on that, around certain trigger points, or how frequent or infrequent should you be doing assessments, or what should we be monitoring from an outsourcing point of view as well?
I think some of these can be a little bit tricky, right? Because we don't have the person asking the question live. They're limited to typing it in. So we're going to guess a bit of the context. I think maybe with Michael's question around outsourcing and specified metrics, I don't know if the panel members can see the Q&A button on their screen, but he's asked about outsourcing. Are there specified metrics one must track, or is one free to select what they think is useful to monitor? Now, that's a really tough question to answer, but if I had to go one way or the other, well, I think what you think you need to monitor is probably going to be the same thing that you must monitor, right? If you know your business. So if you're outsourcing customer due diligence to a third party, I'm just going to pick on something that's not too technical. I don't mean that with great respect. But if you're outsourcing customer due diligence to a third party that's performing that, and then they're wrapping up all the information with a recommendation back to an MLRO or someone else in your company that it meets the script or the requirements and they can be onboarded, you'd have to do a bit of a check of that. But also what you'd be checking would be looking at the quality of the CDD that's coming back. And if you're finding that you're sending a lot of the stuff back because it's incomplete, well then, something you're outsourcing in your metrics have guided you to a problem in one of your outsourced relationships. So I think the answer about what you should monitor is not just what you think is useful, because that definition of what is useful comes down to, well, what are your regulatory requirements? Because even at an event this morning, Jürgen from the central bank sort of said, I just want to remind the audience again, you can outsource the activity, but you can't outsource the function. So unfortunately, Michael, the buck stops with us.
And Peter, just to add to that as well, I mean, in previous roles, for outsourcing, I know periodic isn't for, it is what you say it is. So for example, like if we used to do annual risk assessments, however, if your KPIs were trending towards a negative trend in one of your outsourced providers, whether it's intra-group or external, then, as part of your policy, it would trigger an out-of-course review. So I think as long as you can, as long as you've set out explicitly what your what your timeline is, and you have your KPIs maybe on a monthly basis, and if it signifies a problem in one of your services, then that might require a more frequent assessment. But yeah, I think as Peter said, the metrics that you kind of put in are really specific to the type of outsourced activity. And I think as long as you're specifying that in your even in your register, for example, whether it's critical or not, and having different escalation paths for both of those, I think that would suffice.
Yeah, and I think that sums up Gary's question as well about those trigger events, and I think just documenting them as well, Edith, like that in some sort of a policy document or something like that, just to say that these are the trigger events that could potentially lead to a more frequent risk assessment or monitoring, for example, of a critical service provider. At least then we have the rationale backing up why or why not why we're not doing it, basically. So and then Tracy, there's probably one specific on the IAF and its applicability to credit unions, or sorry, to SEAR, and why it doesn't apply to credit unions. I'm not too sure. Do you know that off the top of your head? Or again, with some of these questions, we might have to come back to via email maybe, and we can circulate to attendees rather than trying to answer them all on the spot.
Yeah, no, I can answer that. Well, I suppose the first thing to remember is that SEAR could apply to other sectors in the future. So it's not to say that SEAR will never apply to credit unions. And I guess just back to the central bank's, continuous message around risk-based supervision, risk-based regulation, risk-based allocation of resources, etc. It may be just from a policy perspective, the decisions have been taken to focus on those firms where they believe should initially be within scope of SEAR. So there is a possibility that SEAR could be extended in the future to other sectors. It is ironic because some of the policy around, deciding who comes in scope is those that are more customer focused, and you probably couldn't find an institution or a sector as customer focused as the credit union in Ireland. I actually am involved in a credit union myself, but that's in the north, and the UK regime is applicable to those senior staff and volunteers in credit unions as well. So it remains to be seen. It may well become in scope down the line, but it's probably just not the priorities, of the central bank just at this point in time, I would suspect.
Look, it raises another interesting question. I mean, I think, we see now that credit unions in Ireland are involved in mortgage lending. They're doing more and more. They're becoming mini banks, yet they're still run by volunteers. And I think it goes to a point just around, talent and recruitment. And I'm not indicating anything about the talent on the board of credit unions, far from it. But particularly, they're going to need different skill sets. And maybe the credit union movement needs to move away from the idea that the directors can only come from the membership base. There may be somebody that's not a member of the credit union elsewhere that's available to provide those director services, right? So that's not a push for anything. I'm just an observation, because I think it takes to that point that there is a war for talent. And Chris, it does come a lot into this discussion we're having now. Companies still coming into Ireland looking for operational risk and compliance experts. Companies that are already authorised need to beef up to meet new regulatory requirements. We can touch on Dora if we need to, but isn't recruitment becoming a real challenge? And that's something which is a little bit of a worry, because to get the right people on board, they need to be educated into what your business model does. You might be a new fintech business model that hasn't existed or launched from Ireland before, and you need to take all those things into account, because that then feeds into the competence of the individual as part of the fitness and probity framework. So I have a general question that is, with all these rules and regulations and the overlay of individual accountability, whether it's a board director or whether it's a senior executive management individual, are we going to find it harder to source these roles locally in Ireland? Does anyone have any thoughts on that? Or maybe I just made a political statement.
That wouldn't be like you, Peter. I suppose I'll maybe talk from the perspective of, having been a PCF and having seen through applications for PCF appointments, that it is quite an arduous process. First of all, finding the talent is difficult across the board. And if you're a startup, for example, and you need to have these people in situ before you even look at an authorization, then, it is, it's a challenge. And then on top of that, now you've got all this additional layer and worry about the threat of enforcement action and all of this accountability that comes with it. So I guess there is a concern out there that, it might put some people off applying for PCF or control function type roles, and shying away from it, again, adding to this whole recruitment challenge. And then you have to kind of cover your tracks and evidence your compliance and all of that. So it just adds an additional level of pressure to anyone in those roles or thinking about it. But then on the other side, the SEAR regime and the conduct standards as well, it does force firms in a way to really knuckle down the roles and responsibilities of a particular person's role. And that's comforting, because it also means that, the allocation of resources is a bit more sensible in terms of, like, when you actually set out someone's roles and responsibilities, you can clearly see that this isn't going to work for one individual to have the sufficient time and capacity, etc., to carry out those functions. And then you have to look at how they're shared across the organization. Also, like, people knowing this is my job, this isn't my job, that can, be comforting to know what is in scope and what isn't, where your responsibilities start and end, and where someone else's responsibilities start and end. So it's kind of a double-edged sword, where you have got that concern about the additional accountability and threat of enforcement against you as an individual. But on the other hand, I think it does provide that sense of clarity of your role, your description, and your responsibilities. And I think that's a nice place to be in any organization at a senior level.
Yeah. I see there's a question that's come in about expectations of the central bank for OpRes and Dora as at January 2025. And I note in terms of horizon scanning, Edith, you'd have some thoughts there on Dora. For my own response on that is that at an event I was speaking at this morning on Dora, the gentleman from the central bank said, look, we don't expect 500 staff from the central bank are coming out on that date in January to perform inspections on the implementation. I think, parking what he said there, we also discussed about where we are with Dora. And right now, batch 1, for those involved in the technical side of Dora, has been submitted by the ESAs. That's all taken care of back in January, and the Commission has agreed those. We've got batch 2, which is due in July, but it feels like that when this date of the main piece of legislation is due to come in on the 25th, that we may not have a lot of the secondary legislation agreed. So I wonder whether the expectation is, as of January 2025, you can demonstrate certain things, such as your registers, that you've identified ICT risk management, you have an ICT risk management framework. And there's one thing I just point out, because it's in Article 8 sub 2 of Dora, is that Dora is not like a puppy. It's not just for Christmas 2024, January 2025. It's for life. And even in the article, it sort of says, look, financial entities on a continuous basis shall identify all sources of ICT, information communications technology risk, in particular, the risk exposure to and from other financial entities. So I think there needs to be a level of that framework and proof of those steps being taken, obviously with your projects and board support. So I'll stop there, because Edith, you may feel like jumping in.
No, I suppose just as a continuation, I mean, there is obviously a great link between Dora and the operational resilience framework and assessments that, we've all put in place over the past 18 months, 24 months. And, I think we discussed before in preparation for this call, one of the biggest challenges and questions that, you know, are coming up again with peers is around, you know, the third party management of, you know, the big players in the ICT, whether it's Amazon, Microsoft, etc. You know, how do firms demonstrate compliance with Dora, you know, when, you know, you can't force the big players to share with you incident management, their BCP, their operational resilience. And, you know, there's a lot of investment firms sitting and waiting, you know, how is this going to play out eventually? Because I think everyone agrees that this is the right approach. But, you know, is there any move to, we say, put pressure directly on these third party big vendors to provide their clients with operational resilience, comfort, and incident management feedback? Or, you know, is it always going to be a black book? How do we become compliant with something when we've no control over the big players?
Yep. Yeah, indeed. Absolutely. Listen, Chris, I think we're up against the clock now.
I was just going to say, I think we only have a few minutes left. Yeah. So I think I might pass it back over to you, Peter, maybe to kind of wrap it up with your piece, if that's okay.
Yeah, sure. I think maybe what we might do is guys, this is just a depiction. And again, fintech's a broad church, but depiction of fintechs ranging from e-money firms through to virtual asset service providers through to open banking and crowdfunding. So just to give an idea of I think it's now 69 regulated fintechs, but of course that's being disrespectful to someone like Edith, because Virtue is obviously a fintech, but I haven't mapped the MiFID companies in this exercise. If you just jump through to the next slide there, Chris, I'll just say quickly, look, we won't stop on this slide, but we were all aware of the priorities that came out on the 29th of February. But what was more important was the message with these supervised priorities, and that these are the outcomes sought. Now, the one topic we didn't get a chance to talk about today, but not really on the agenda, would be priority 5 for a lot of us in financial services around climate change and net zero. That sits on top of everything else we discussed. I think priority 6 about the way the central bank enhances how it regulates and supervises is going to be interesting for a lot of us. Now, if you jump to the next slide there, Chris, the key regulatory initiatives, again, look, I won't stop on this, but this is what the governor told the Minister of Finance, that are the CBI's key regulatory initiatives. And you'll see some of the regulations we've already spoken about. Dora, we haven't touched on the crypto asset regulation, but it's there. And of course, the modernisation of the code. If you just, and AI, another topic, or, you know, we could spend hours on, because that European AI Act is going to have an impact on the policy work and supervisory responsibilities of the CBI. If you pop to the next slide, Chris, people are no doubt screenshotting these as we go through, but I know the slides are going to be available to the attendees. This is really a history. For those of us in e-money and payments, we got a letter back in 2021 in December. We got a further letter in January 2023, and we had deadlines to meet. In the last letter, one of them was around safeguarding, which seems to be a hot topic for the regulator, as well as you'll see operational resilience and outsourcing. So these themes continue to come back, including our old faithful AML there on the right side. On the next slide, which is probably where we'll stop, is actually, if you jump to the next slide, sorry, and this will stop here. The previous slide we just skipped through was just a highlight from an event the central bank ran on the 29th of February for e-money and payments firms. But it was very interesting for firms that may not have been in that industry. Now, we got told a number of things. We got told safeguarding audit, there were some issues identified, 287 findings were identified relating to safeguarding, from governance through to actual safeguarding accounts, IT controls and systems, and reconciliations. And in purple, I've just cut and paste what we were told, that the regulator has found examples where firms were meeting safeguarding requirements effectively, and the levels of findings are such that that the work we have to do to ensure customer money is fully protected. So there's some positives, there's some negatives. Wind down planning, we can't go into that, but that's another hot topic. And I expect we'll see these things in a DCEO letter sometime today. I don't see it at the moment at 11 o'clock, but maybe my cache on my internet's a bit slow. So I'll stop there, Chris, because the slides I've skipped through, everyone will get, but it was just really to put a bit of flavour and give identification to source material where we see these supervisory priorities and expectations come from, because they're not necessarily in legislation.
Yeah, that's a great summary. And yeah, I think we're all kind of eagerly waiting that your CEO letter today, Peter. So you can be sure that most of the audience will be sitting in front of their Outlook inbox waiting for that to refresh. So Just a quick thank you from all of us for our guest speakers here today. So Edith, Tracy, and Peter, and then to everyone who attended as well. So I'm conscious we're just on the nose for time. So we'll send out the slides later today. And if anyone has any questions, do feel free. If you reply directly to that email, we'll pick up any questions that we maybe didn't address today or anything we skipped over too fast. And again, thank you for your time, everyone.
Thanks. And Chris, will the speakers wish to stay on the video call until the end?
Yeah, that's perfect. Yeah,
Okay,
yeah.
that will stay on. Okay. Thank you, everybody.
Thank you.
Thank you.